In this slide, we will talk about the yield to maturity of the company in short-term and long-term bonds for 2009 and 2010. Firstly, we'll start with 2010 with the long-term bonds. In the slide, we can see right now that the 2010 bonds were supposed to be matured in 22 years, and with the maturity rate of coupon rate of 6.75 and the current price of 116.9, the semi-annual frequency yield to maturity was 5.42. But if you look at the short-term bonds, the coupon rate was 6.625 for it, and the yield came up for 2 years was 0.97%. The company talks about that how we see into what were the changes in 2009-10. So we will tell you what the long-term bonds yield to maturity was in 2009. With the same coupon rate of 6.75 and the current price that time was 91.4, the yield to maturity semi-annually was 7.54. And if you look at the the short-term bonds for 2 years maturity, it came up to 1.69% semi-annually at the rate of 6.625 for the price of 116.5.
The WACC is founded by adding up the weight of equity times the cost of equity and the weight of debt times the cost of debt. In 2010, Heinz's weight of equity was 30% and their cost of equity was 9.74%. And then their weight of debt was 70% and their cost of debt was 3.97%. When adding these up, you get a total WACC of 5.70%. In 2009, their weight of equity was 20% with a cost of equity of 12.75%, and their weight of debt was 80% with a cost of debt of 3.88%. This led to a total WACC of 5.66%.
The weighted average cost of capital for Kraft uses SML to calculate the cost of equity under the assumption that the market risk premium is 7.5%, and the risk-free rate is based on the 10-year bond rate. The tax rate is based on Heinz 3-year average as shown in Exhibit 2. 57.7% of Kraft is financed through equity, and 42.2% of Kraft is financed through debt. Their cost of debt is 3.6%, and their cost of equity is 8.6%. Their weighted average cost of capital is 6.49%. The weighted average cost of capital for Campbell's Soup uses SML to calculate the cost of equity under the assumption the market risk premium is 7.5%, and the risk-free rate is based on the 10-year bond rate. The tax rate is based on Heinz average over 3 years as shown in Exhibit 2. 21.7% of Campbell's Soup is financed through equity, and 78.3% is financed through debt. Their cost of equity is 7.8%, and their cost of debt is 3.1%. Their weighted average cost of capital is 4.12%.
When we attempt to find the weighted average cost of capital for Del Monte Food, we need to first assume that in the absence of tax information, the tax rate will assume to be 0%. By multiplying the weight of equity and the cost of equity and adding it to the weight of debt multiplied by the cost of debt, we estimate that the weighted average cost of capital for Del Monte Food will be around 8.06%. Since the weighted average cost of capital of Heinz is lower than its other competitors, we need to examine the debt ratio of the company to see if it is higher or if the company is financed through retained earnings. What we should note, however, is that the weighted average cost of capital is not enough to determine whether Heinz is more successful than the other companies. Net present value and the cash analysis must also be checked in order to get a better understanding of how Heinz is performing.